Okay, Assalamu alaikum and good evening, students. Uh, this is Mustafa Mirchawala from Mirchawala's Above Accountancy, your F7 FR trainer. Uh, the objective of this revision day is basically motivation, because we have already covered things in very much detail. You have taken almost 100 hours plus classes, and I have already recorded all the latest past papers. If you go to the accglobal.com, the two latest past papers of last, because ACCA just gives you the past papers of two attempt combined, like March, June is a combined one. March, June. You can hear me? Can you hear me? Yes, it's okay. Now, so ACCA gives you the past papers of combined for two attempts. March, June, it's a single attempt. They declare one single attempt, and then September, December, they declare one single attempt past paper, right? So these all past papers are already solved. Even I have uploaded on YouTube as well. So they are very much relevant for you. You guys must watch it. And normally ACCA gives you last 40 marks. Okay. So this is normally students complain about that we have less resources for MCQs and OT cases. So that's why this time I decided to discuss the first 60 marks question with you. So I have some new questions, like it's a mock exam, and we'll be discussing first 60 marks of it. So it will be quite refreshing for you, and the objective is just motivation. The objective is just motivation, right? Okay. And for your motivation, you can see in front of the screen, these are the position 12 position in just one attempt. In just 1 quarter, our institute scored 12 positions, and out of these 12 positions, 9 positions belongs to my students, in which 3 are SBR positions, 3 F6 position, 1 F7, 1 FA2 world top, and 1 F3 Pakistan top, right? Now, not only our students score the positions, but let me share for your motivation, because now these are ending days, and believe me, these days are very important. These days are very important for results. Normally, majority, even the position holder students, work hard in these last month, right? This last month. So you can see some of our marks, although all students, they don't reply on the result day, even they are busy, I don't know why, but I have gathered some marks of last attempt. You can see these are normal student. They also study like you. They took normal lectures, revision days proper. They availed the marking facility for ratio analysis. They read the examiner report. They did mock exam. This is the normal routine. One reminder I would like to give you, this time and even the last time as well, ACCA UK also giving you guys free mock, but the last date is 23rd May. So I have already shared the link. With you guys. So you are requested to come do the mock before 23rd May. You are requested to do that mock before 23rd May. Okay, don't waste time now. Otherwise, and those questions are very good. Some students gave me feedback that very technical questions in the ACCA mock. I'll share the link after the class. Remind me, okay? It's on my ACCA. I think if you go to my ACCA, you'll find it. Now, let's start. 60 marks almost. In your exams, you have first 30 marks MCQs, which may come from any area, and then you will have 30 marks OT cases. So let's start. The first thing we are going to start is the EPS question number one. Now you guys, or you all know, there are two types of EPS. Number one is basic EPS, and number two is diluted EPS. Basic EPS contains real things. Okay, before we move on, before we go forward, keep one thing in mind. We are not doing normal classes, please. This is revision days, and it is assumed that in revision days you must know all the IFRS, okay? Please, because you all have taken the normal classes, you all have studied the normal classes. Although I'll try to discuss things with basic with through a basic teaching style, spoon feeding style, but still you must know the IFRS. Okay, right? Now, so there are two types of EPS. One is basic EPS and the other one is diluted EPS. Basic EPS is basically a reality-based EPS. It contains real profits and real shares, real profits, real shares. Okay. And diluted EPS, what is diluted EPS? It contains reality plus imagination, It contains potential contracts as well, like convertible loan notes, like share options. Okay, right? Now, this question is related to basic EPS only, right? First of all, you need to check your accounting period. Can you see the first line? This is your 31st December, X2 is your accounting period. So obviously the beginning of the accounting period is 1st Jan X2 to 31st of December X2. Okay. Now, this is your accounting period and you have ready-made profit after tax. Thank God you have profit after tax. That means the numerator is ready. No issue. Now, at the start of the year, Mod had 6 million shares. Already the year starting shares is 6 million shares. Okay. Now, on 1st September, see, this is the date. This is the event, 1st September, X2, Mod made a bonus issue of 1 for 8. 1 for 8 bonus, 1 for 8 bonus. So this is very easy because in your classes, in your routine classes, you guys have done even multiple issues. Remember the multiple issues topic? In one single accounting period, you used to do 2 or 3 types of share issue: bonus issue, right issue, full market price issue. Remember, 2 or 3 share issues. But in this question, there is only one issue. And you know, bonus issue is a free issue. So we just simply take the impact of bonus shares from the beginning of the year. We just simply take the effect of bonus shares from the beginning of the year, right? And how are we going to take it? Through bonus fraction, through bonus fraction. Okay, right? Now, 1 for 8. Can anybody tell me one? Originally we had 100%. Originally we had 100%, right? Original shares were 100%. And now 1 upon 8 is how much percent? Can anybody do it? 1 upon 8 times 100. Do it. 1 upon 8 is how much? 1 upon 8 is how much percentage? 1 upon 8 times 100. Can anybody do it? 12.5%, right? So if you do 12.5%, this will be, if you add this 12.5%, this will be 112.5, and then you divide by 100. To remove percentage signs, you divide by 100. So 112.5 divided by 100. This, look at very carefully. This, you can call it your bonus fraction directly. This number, you can call it your bonus fraction directly, or you can do it like that. If you divide it, it will become 1.125. This is also perfect. 1.125 is also perfect. You must know basic maths. You write it in this way. This is also perfect. Or you can write it 1.125. There is one more method. Those who know maths, there is one more method. Originally, we had 1 plus 1 upon 8. See, if you have done maths in your life, 1 complete whole number 1 plus 1 upon 8. So if you know how to add it, this will become 9 upon 8. This is your bonus fraction. So those who want to use 9 upon 8, again, it's perfect. Those who want to use 1.125, again, it is perfect. Just for your verification, use your calculator and write 9 upon 8. Just for your verification, use your calculator and do 9 upon 8. It's equal to 1.125. Okay. So in maths, you can do it through fraction. You can do it through decimal. You can do it through percentage. All things are correct. No need to worry about this issue, right? Okay. Now, how to do it? Let's start. First of all, you have only one issue in this year. So you will write EPS. Your profit is how much? Your profit is 565,000. And your number of shares were 6 million. And now you want to incorporate the impact. You want to incorporate the impact of bonus. So the impact of bonus is 9 upon 8. Okay. So simply multiply your shares by 9 upon 8. Automatically bonus shares will be adjusted. Automatically bonus shares will be adjusted. Automatically bonus shares will be adjusted. Can anybody tell me what is the answer? Can anybody tell me what is the answer? It's 8.4 cents. It's 8.4 cents. Now, this is the EPS of December X2. This is the EPS of December X2. Now look at here. Don't forget, whenever in any accounting period, there is a bonus issue, we need to restate. We need to restate last year EPS as well. We need to take the impact of bonus issue in the last year EPS as well. And how to restate? Look at here. Students, look at here. You will be given the last year EPS. Mall reported a basic earning per share figure for the year ended 31st December X1 is 11 cents. So the examiner will ready-made give you the last year EPS. And how you gonna do it? Last year EPS times reciprocal of bonus fraction. Reciprocal. So restated EPS will be December X1. Last year EPS is 11 cents times 8 upon 9. Times 8 upon 9. What is the number? Please tell me. 0.098. It's 9.8 cents. Okay. So this is your answer. You have, student, this is very simple question. You did more difficult question than this. So your current year EPS is 8.4 cents. And with this current year EPS, you will be reporting a restated EPS of 9.8 cents. 9.8 cents. 8 cents. Answer is A. Answer is A. Answer is A. Right? All of you, please join the WhatsApp group. Our admin has sent a link in the chat box. In the chat box, admin has sent a link. Please join that WhatsApp group. That will be useful for you. Okay? For our further discussion. All of you, please join the WhatsApp group. So this is how we did question number 1. 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 Now, question number 2. Question number 2. Let me enlarge the screen and giving you guys, wait 1 minute to read it and make the plan. Giving you guys 1 minute to read it and make the plan. Giving you guys 1 minute to read and make the plan. It's about consolidation. There is a dodge in this part. There is a dodge in this part. Giving you 1 minute to make the plan. Make the plan. Quick, do it. Okay, now first thing, on 1st October X8, student, let me discuss. First, Paula acquired 80%. Very important thing is the acquisition date. The most important thing is acquisition date, which is 1st of October X8. Don't forget this. And the second important thing is 80% at 80% shares of the 1 million shares in Stella. Okay, go slow. My dear student, first of all, S company has total issued share capital of 1 million and parent company only acquired 80%. So 1 million times 80%, 1 million times 80%, that means P company has just acquired 800,000 shares of S company. Keep this thing in mind. Okay, and then go slow. By way of a share exchange, very simple, 2 new shares in Paula for every 5 shares acquired in Stella. That means, look at here, that 5 shares will come from S company, and in return we'll give 2 shares of P company. 2 shares of P company. The simple rule, the simple treatment is just write this 5 in denominator and 2 in numerator. That's it. This is the fraction. 2 divided by 5. Whatever we are giving, put it in the numerator, and whatever they are giving, put it in the denominator. That's it. So listen, whatever, how many shares we have bought from them? 800,000 shares, 800,000 shares. Listen, times 2 upon 5, times 2 upon 5. Now you tell me how many shares we gave them. 800,000 shares they gave us, and you know the deal is 2 over 5. The deal is 2 upon 5, 2 upon 5. So that means we issued 320,000 shares. We issued 320,000 shares of P company. Parent company issued 320,000 shares. Okay, now let's see what is the price. What is the price per share of P company? Now wait. On this date, the fair value of net, leave it. Paula's share, yes, P company share price was 5.4. Okay, so now can you tell me how many shares we have given? We have given 320,000 shares, and what is the worth? What is the worth of one share of P company? It's 5.4. So if you want to calculate the COI, if you want to calculate the cost of investment, it will be 320,000 shares times 5.4. Now wait. How much is this? 1728. Yes, sir, thank you. 1728000 is your COI. Now, there are 2 types of methods of goodwill calculation. One is full goodwill method and one is proportionate. Let's see the method. The method is, yes, goodwill using fair value method. Fair value method is full goodwill method. In full goodwill method, one more thing will be given in the question, and that is fair value of NCI. Look at this. Fair value of NCI is 850. Can you see this? So now we'll write fair value of NCI at acquisition is 320,000, right? So if you add these two, then you need to deduct less fair value of net assets of S company. Very basic thing. Fair value of net assets of S company. Anything is given? Yes. On this date, the fair value of Stella's, yes, S company's net asset was 2 million. So fair value of net asset is 2 million. Fair value of net asset is 2 million. Now, if we deduct this 2 million, what is the goodwill? What is the goodwill? Oh, sorry. NCI is 850. Yes, I copied it wrong. NCI is 850. Sorry, my bad. This is 850,000. I copied it wrong. So can you tell me what is the goodwill? The goodwill is 578. Now this was so straightforward. This thing was so straightforward. Now listen the dodge. First question. We compute goodwill at dash date. We compute goodwill at dash date. Acquisition date. Yes, we compute goodwill at acquisition date. So this goodwill is at acquisition date, right? And acquisition date is 1st October. Acquisition date is 1st October. And you know, impairment happens in the post period. Impairment of goodwill always happens in the post period. It's a post period thing. Okay. So now read some irrelevant stuff. It is written in the year ended. Look at here. In the year ended 31st March X9, goodwill had been impaired by 200,000. See, this happened in the year ended 31st March X9. This happened in the year ended 31st March X9. That means in the post period. This happened in the post period. Now read the requirement. What is the value of goodwill arising on the acquisition on 1st October? See, this is the acquisition date. They are asking goodwill on acquisition date. They are asking goodwill on acquisition date, not after 1 year. If they would have asked in the question to report goodwill after 1 year, that is on 31st March X9, definitely then the answer would have been 378. But they have asked on acquisition date, so the answer is 578,000. Okay, so in my routine classes, I say this dialogue many times, that examiner gives you irrelevant stuff. Sometimes examiner give you irrelevant stuff as well. So be very careful with such irrelevant stuff. Okay. Yes, correct. Impairment happened after acquisition date. It always happens in the post period. Okay. And it is written as well. Okay. So this was our question number 2. You will get these slides. Whatever I'm writing here, you will get the slides after the class on the WhatsApp group. Okay. Don't worry about it. Now, question number 3. Question number 3. On first, there are some students, they are saying they can't listen, so they need to change their settings. Otherwise, the sound is perfect. Now, on 1st April X7, Priya acquired 100% of the Skyla for 6 million. See, this is COI. This is COI. COI. At that date means acquisition date. At that date means acquisition date. Okay. The fair value exercise was performed and the fair value of Skyla's net asset. This is fair value of net asset. Now, this is the basic baby question. Listen, no NCI in this question because of 100% holding. No NCI in this question because of 100% holding. Okay, listen. You will write COI, how much? 6,000 less fair value of net assets of S company, which is 7,300. So just look at here. Here you see a negative goodwill, and the clear word for negative goodwill is gain on bargain purchase. The real word for negative goodwill is gain on bargain purchase. Okay. Now, in simple words, we all know gain on bargain purchase means we bought expensive company in a cheaper rate. Parent company bought an expensive company in a cheaper rate. So it's nothing but a gain. It's a benefit. So it's your income. It's your income, pure income. It's your income and it will go in the P&L. It's your income and it will purely go in your P&L, right? Okay. Now look at here. Look at here, dear students. So this is the requirement. This is the requirement of consolidation. You know, whenever parent company acquires subsidiary company, parent company brings each and everything of S company to fair value. Parent company brings each and everything of S company to fair value. So obviously, S company's net assets are recorded at fair value. You know that. Okay. And now this time, instead of positive goodwill, we get a gain on bargain purchase. So this thing will go straight in P&L. This thing will go straight in P&L. I'm sure you can guess the answer. You have all the options. Please take it out. Let me read it. A, record the net asset at the values shown above and credit to, no, we never credit goodwill. We write P&L credit. So this is wrong. Now, record the net assets at their values. Yes, these are fair values shown, and credit profit and loss with yes. This is the answer. All the net assets are recorded at fair value, and this thing will go in P&L. This gain on bargain purchase will go in P&L. Okay. Now, ignoring the brand. No. Ignoring the brand, record remaining assets at their. That's wrong. Both C and D are wrong. Even the numbers are wrong. In C and D, even the numbers are wrong. Okay. Are you guys with me? Are you guys with me? Okay, now question number 4. Very interesting question, and I really like this question because in this question, I will teach you one thing. In theory question, you have to pick the most appropriate answer. In theory questions, you have to go for most appropriate answer. And in this question, you will find two answers correct. Look at here. Which of the following should be accounted using equity accounting in the console? Equity accounting means associate. Whenever a certain company is my associate, then I use equity accounting. And for associate, for example, I'm P company, I have 30% shares in A company. So for associate, in order to prove a company that this company is my associate, you must have significant influence. You must have this word significant. And you know what is the definition of significant influence? Significant influence means power to participate in financing and operating policies of an entity. That means you can access the board of that company. You can access the board of that company. That means there are some directors in the board, so that your voice can go in that board. Your voice can go in that board, right? So now let's start. And invest. First of all, I'm going to read C and D. For associate, normally there is a standard criteria is 20 to 50, that you must have shares more than 20 and less than 50. This is the standard percentage rating, more than 20 and less than 50%. And this is sometimes also called bright line criteria. More than 20, less than 50. Okay. Now check the C first. An investment of 18% of ordinary shares. No, 18%. I'm right. I'm reading C. 18% is less than 20. Plus, there was no such significant influence guidance. There are no other agreements, no more directors discussion, nothing else. So C is wrong. There is no significant influence. Read the D. An investment in 35% of the non-voting. Even right now, we don't have voting rights. So how can we influence? So C and D is totally wrong. C and D, my dear student, is total wrong. C and D is total wrong. Okay. Now come to A and B. Look at here. A, an investment of 40% shares. We have 40% shares in this company, Artrim. The remaining 60% shares are owned by Rosven PLC, who treat Art, right? Our company has 60%. Okay. Now that means this A company is under the control of this R company. A company in which we have 40%. A company in which we have 40% is already under control of some other company. But to be very honest, this thing I teach in SBR level, in the official IFRS 10 document, in the, listen my words, listen, open your ears. In the official IFRS 10 document, it is written, in SBR paper, it is written that it is possible that the company is in control of some other company, and at the same time, we have significant influence in that company. This is possible. Yes, this is possible. There is one single company who is the subsidiary of A, but the associate of B. Yes, at one time, this is possible. I repeat, this A company, 60% owned by R and 40% owned by P. So it's already under the control of R. Yes. And there is a possibility that P company has significant influence. These two things are possible at one time. It is written in IFRS 10. That's why this MCQ, we can correct it, but still the information is ambiguous. Why? They didn't discuss the directors issue. They didn't discuss the directors issue, that how our directors participate, okay? So that's why I'm right now silent. Let me read B. An investment of 30% of the ordinary share in ACCA Prima has one representative of ACCA board of directors. C. Now it is clearly they are saying in B, openly they are saying that yes, we have one board of directors. So our voice is going in that board. So in B, there is a clear cut indication of significant influence. That's why I will go for B. There is a clear cut indication of significant influence. That's why I will go for B. Otherwise, A may also be correct. A may also be correct because it is written in IFRS 10. In the advanced level IFRS 10, official IFRS 10, it is written that one single company has been controlled by an entity X and has been significantly influenced by entity Y at the same time. It is possible. Yes, it is possible. So A may be correct if they give you details, if they give you more details, but in this question, they haven't given you more details, and this is the MCQ. So in MCQ, you can't discuss things in theory, you just have to pick one. So the most appropriate and the best answer is B. I hope you got it. Okay, this is a piece of cake. Very good question. And as we know what date it's today. So by now, you all must have completed the course. This is deemed thing. By now, you all must have completed the course. So this is related to SOCF. SOCF, statement of cash flow. Did you guys do statement of cash flow? Have you gone through the lectures of SOCF? This is straight away from SOCF. This is straight away from IS7 statement of cash flow, right? And what you have to do, you guys see there are two years, this year and this year. Easily you can recognize 2008 and 2009. 2008 is opening numbers. These are opening numbers. Opening. These are closing numbers. These are opening numbers and these are closing numbers. Opening and closing. Okay. So you write down the opening and closing balance and then write down this number. So you will get a balancing figure and then you can do it. Totally IS7 statement of cash flow, nothing else. Nothing else. Nothing else. Let me do it for you. Wait. See, this is the deferred income account. Deferred income account. You will write the opening balance. Tell me, how much is the opening deferred income of government grant? 1100 is non-current and 650 is current. So opening is 1100 plus 650. This is your opening liability. Your opening total liability is 1100 plus 650. Now come to closing. Closing, your closing total liability is, wait, 1250 plus 850. Okay. This is your opening and closing. This is your opening and closing. 1250 plus 850. Now wait. During the year, what happens? Read the question now. On 1st July X8, on 1st, see, this date falls in our accounting period. Check our accounting period. Your accounting period is ending on 31st March X9. Use your brain. Your accounting period is ending on 31st March X9. That means your accounting period is going to start on 1st April X8. So yes, this date, 1st July X8, falls in your accounting period. Tamsin received a government grant of 500 for the cost of an item of plant. Listen, hope you remember the basic lecture of IS20. Whenever we receive government grant, we make this entry. You remember this? Bank debit 500 and deferred income credit 500. Bank debit and deferred income. Remember, why don't you book P&L immediately? Tell me, why don't you book and make entry bank debit 500 and P&L credit 500? Because of matching principle. If you book P&L immediately, that means you are going to book. That means you are going to book years of income in one go. 5 years or 10 years income in one go, which is not appropriate. Okay. So you make this entry bank debit and deferred income credit. Okay, now open your eyes. I have just made the entry for 500. Now post this in the account. So see, in this entry, we are doing deferred income credit. Deferred income credit. So it will come here. Okay. Can you see now? Wait. Now what will happen? Look at here. What was your let me teach you with a different style. What was your opening deferred income? Tell me, all of you. Your opening deferred income was 1100 plus 650. It's 1750. Opening deferred income was 1750, and then it increased by 500. Opening deferred income was 1750, and then it increased by 500. So 1750 plus 500 is how much? 1750 plus 500 is 2250. So obviously, if you add these two, your closing balance must be equal to 2250. Your closing balance must be equal to 2250, but your closing balance is not 2250. Your closing balance is not 2250. So that means your liability went down. Your liability went down. So what is the reason? What may be the reason? Your liability is amortized. Remember, we used to amortize the deferred income. We used to amortize the deferred income. So how much is the balance? It's 150. How much is the balance? It's 150. And should I make the entry for this 150? This is the entry. See, for this deferred income debit, 150 and P&L credit 150. Deferred income debit 150 and P&L credit 150. Deferred income debit 150 and P&L credit 150. Okay. Now, what you have to do, students, you have to post these two entries in the cash flow. Students, you have to post these two entries in the cash flow. The first thing, can you see this entry? Look at this. Can you see this entry, this second entry? In the second entry, there is a P&L but no cash. In the second entry, there is an income but no cash. So this is a non-cash income. In the second entry, see, deferred income debit, P&L credit, there is an income but no cash. So definitely it's a non-cash income. And you know, in the statement of cash flow, non-cash incomes are deducted. Non-cash incomes are deducted from operating activities. Non-cash incomes are deducted from operating activities. So 150,000 will be deducted. 150,000 will be deducted from operating activities. Number one. Number two, see, you have received this 500 cash. Can you see this 500? So government has given you, look at here, government has given you grant for investment. Government has given you grant so that you can do investment. So that's why you add this 500 inflow. Check bank debit. You will add this 500 inflow in the investing activities. So this is going to be, answer is D. Answer is D. Answer is D. Those students who know about the statement of cash flow, they can easily do it. Even we have done this in class as well, 2 times, I think. Okay, now let's move for an easy question. Now, in the year ended 31st March X6, connect revalued properties. So whenever we revalue a property, normal entry is PP debit or asset debit and revaluation reserve credit. Okay. Now, which of the following ratio would be distorted when comparing year-on-year performance and position? Okay. Answer is very simple. Very simple. Current ratio, no, because the formula of current ratio is current assets upon current liabilities, and in this entry right now, which I just made, there is no current assets and current liabilities. Okay. Number two, asset turnover. Yes. In the asset turnover, the formula is sales upon capital employed. Yes. So in capital employed, we write equity. In capital employed, we write equity, and this revaluation is an equity dependent event. In revaluation, equity moved. So yes, this revaluation will impact asset turnover. Yes. This revaluation will also impact gearing. Yes, gearing. You remember gearing, debt divided by debt plus equity. The formula of gearing is debt divided by debt plus equity. So yes, as you are moving this revaluation reserve, which is the part of equity, so gearing will be affected. And finally, yes, return on capital employed. The name is capital employed, ROCE, return on capital employed. So in return on capital employed, there is a capital employed. So all these last three, 2, 3, and 4. Answer is D. Answer is D. Did you understand it? Please tell me. Okay. Giving you 1 minute for this. A good one, a good one. Question number 7. Yes, getting correct answer now. All of you, please write on the chat box. Guess your answer. Let me check. Yes, the answer is B. Very good. Very good. You know, this is enhanced. There are 2 types of qualitative characteristic. Remember fundamental, and the second one is enhancing. So there is one thing which we call it comparability. Now, which of the following will improve? Recording transaction according to their substance. No, this is substance over form, and substance over form improves faithful representation. So A is not the answer. Now look at B. Restating prior year earning per share figure following a right issue. Yes, we all know whenever there is a bonus issue or a right issue, whenever there is a bonus issue or a right issue, you restate last year comparative EPS, and why you do it? So that the comparison is like with like, so that shareholders won't take a wrong decision. Remember, because they compare it. So in order to improve the comparability, we do this. Okay, so B is the obvious answer. Now C, including assets held for sale within no. This is it. This itself is wrong statement. Held for sale assets are recorded in current assets. Held for sale assets are recorded in current asset. Remember? So this is wrong. D, recording a change in accounting estimate in the current year financial statement. This is the issue of information. You know, IS 8 says changes in accounting estimates are adjusted prospectively from now and onwards. Why we do this? Because accounting estimation depends on availability of information, and this information was not available in past. So we'll adjust it from now. So this is the information issue. So the obvious answer is 7. Answer of 7 is B. D is basically change in accounting estimate. That is information issue. Information. Accounting estimation depends on availability of information, and that information was not available in past. We just got that information, so we'll adjust it from now and onwards. Okay, so that's not about comparison. Very good, excellent question. Question number 8. Let's see who does this. Question number 8. Come on. Question number 8. Excellent. Listen. Which of the following accounting treatments provide an example of relevance? Restating the financial statement of previous year prior. No, this is about the comparability. Treating redeemable preference shares as a liability within the financial statement. This is about substance over form. And you know, substance over form, look at, increases the faithful representation. Substance over form increases the faithful representation, not relevance. Valuing inventory within the financial statement using FIFO? No. Totally irrelevant thing. Now, separately disclosing discontinued operation within the financial statement. Now wait. Whenever I teach this topic, I say my students that look at here, providing some information to shareholders and hiding them also hits the relevance. Listen, for example, I am giving you there is one very important information. There is one very important information. If I provide you that information, then your decision will be X. And if I don't provide you, if I hide that information from you, your decision will be Y. So yes, this is relevant information. So hiding something from shareholders is also a relevant thing. And the second thing, style of presentation. Style of presentation also hits the relevance. Look at here. So you guys did IFRS 5. You all have done IFRS 5, discontinued operation, remember? So we all know whenever there is an operation which is going to be discontinued, you in the income statement, you have to make a separate section for continuing operations, and then you write discontinued operation, so that shareholders come to know that this discontinued operation will no longer be part of future. Okay, so this thing is relevant for them. This breakup of presentation is relevant for them. And one more very good thing, those who have read the book, they know this. Listen, for relevance, there is one thing, predictive value. Look at here. Those things or those transactions which have a predictive value. Predictive value means they say something about the future of company. They say something about the future of company. Those transactions are relevant. Yes, predictive and confirmatory value, they are always relevant. They are always relevant. So just think, this discontinued operation has something about the future of the company. This discontinued operation presentation gives a signal to shareholders that don't rely on this segment now. This segment is going to leave. Okay, so D is the answer. D is the answer. So my dear students, question number 9 is very good. It's like F3 level question. F3 level question. Let me explain you. On 31st March, I said, Jinx closing inventory valued at its cost of 5 million. See, total value of inventory was 5 million. Now go very slow. First of all, listen the story. This is the last day. This is the last day of year end. And today I entered in my storeroom. And on the last day, I entered in my storeroom. So all the storeroom is filled of stock. Total storeroom is full of stock, and the total cost is 5 million. So when I just moved around, I saw an item of stock inside that storeroom. I saw an item of stock which was, let us say, obsolete or damaged, or there was some problem with that stock. So what happened? I came closer to that stock and I picked that stock up, and I took that stock out of the room. What is written? See, including, see the word 5 million, and then after comma it is written including, after comma it is written including some damaged goods. See, the word damage itself is self-explanatory. Now we should be alert. There is some problem with this inventory. So now the damaged item cost 390,000. So let's remove these bad goods from the room first. Let's remove these bad goods from the room first, and let's take these goods to the laboratory. Let's take these goods to the laboratory lab for checkup. So how much inventory is left? Can you see? Okay, so remaining inventory is 4610. Now let's go to the lab. This is my laboratory. See, I have written cost here, and here I have written NRV. Wait, what is the cost of these goods? 390. What is the cost? 390. Now let's calculate NRV. Let's calculate the NRV. You know, NRV in shortcut is selling price less cost to sell or cost to complete. So first of all, I need to calculate the normal selling price. Students, look at here. First of all, I need to calculate normal selling price. The damage item costs 390,000 and are no longer expected to achieve their normal selling price. First of all, let's understand what is normal selling price in this question, which is calculated to achieve a markup of 20%. Now wait, markup means profit percentage on cost. Markup means profit percentage on cost. Look at here, I'm writing here SCP. What is the cost? Cost is 390,000. Okay, in markup cost is always 100. This is 20, so this will be 120. Can anybody tell me the normal selling price? 390,000 divided by 100 times 120. 390,000 divided by 100 times 120. First of all, tell me the normal selling price. 468. Thank you. So the normal selling price in good days, they sell this inventory for 468. In good days, they sell this inventory for 468,000. Okay. But now it's not about good days. The time has changed. Now listen, look at here. These goods will have to be sold at a discount of 30% on normal selling price. Discount of 30% on normal selling price. My dear respected student, normal selling price is 468. All of you, please listen. Normal selling price is 468. Can you subtract 30% from 468, or giving you a shortcut? Directly multiply 468,000 times 70%. 468,000 times 70%. Your new NRV is 327,600. This is your NRV. 468,000 times 0.7. 468,000 times 70%. Your new NRV now, the realistic NRV is 327,600. Okay. So we just did checkup in the lab. Now, still this stock is unsold. All of you, please don't forget. Still this stock is unsold and we took out from the storeroom. So we need to add this. So we need to add this stock again in the storeroom. So you remember, whenever we add this to the storeroom, we have to apply IS2. And IS2 clearly says, IAS2 clearly says inventory should be recorded at lower. Of cost or NRV. So which number is lower? This number is lower. So add this number in the room again, 327,600. Can you tell me what is the correct number now? What is the correct number? $4,937,600. Okay, answer is A. Achievable question. Okay, shall we move forward for a very good, easy, your favorite standard, leases, IFRS 16. The next one is about IFRS 16. We are not solving any exam. It's a separate MCQs mock exam. Okay, question number 10. Try your luck. If you want to take the picture of the question, you may. If you want to take because I move the question as well, move the screen as well. If you want to take the picture, you may. You are allowed. Yes, I'm getting right answers. Very good, very good. So now very simple. On 1st April Excel, Daniel acquired a machine via lease agreement and paid 45,000 immediately. This is first payment now. Okay. And first payment now is also part of lease payment. Don't forget, being the first of the 5 equal annual rentals in advance, the present value of the remaining. Okay. So now is 155,000 this date. Now let me explain you. We are at, let us say this is year 0, this is 1 2 3 4 5. Okay, so the present value of future payments is 155, and there is one more payment of first payment now. There is one more payment of first payment now, so the total present value will be 200. If you understand the concept, the present value of future rentals is 155. And what about the current rental? The current rental is also lease rentals. The current rental, the first payment now is also a lease rental. So this should also be part of ROU. This should also be part of ROU. And whatever we are paying right now, open your eyes, whatever we are paying right now has the same present value. So 155 plus 45 is 200,000. Listen. So your first entry will be, let me solve here. Your first entry will be ROU debit 200,000 and lease obligation credit 200,000. Okay. Now, dear student, look at here. On the same date, we said we shake hand with that guy and we said, okay, take first payment now. So we all know first payment now should be treated as pure decrease in lease obligation. First payment now should be treated as pure decrease in lease obligation. So same time we'll make the entry LO debit 45,000 and bank or cash credit 45. Okay. Now you tell me, if we start our schedule, remember the schedule, date, rentals, finance charge, decrease in obligation, balance obligation. Remember this table. So now you all know we'll start our table with the net amount. So 200 less 45, we'll start with 155. We'll start our obligation with 155. Okay. Now you tell me, in this first year, whole year, we use 155,000. We use 155,000 of the other party. Our outstanding loan is 155,000 and interest rate is 10%. Interest rate is, so 155,000 times 10% is 15,500. So this is your interest cost. This is your interest cost, my dear student. This will go in your P&L. If you are going to calculate P&L for year 1, so finance cost or interest cost that will go in P&L is 15,500. Finance cost or interest cost that will go in your P&L is 15,500. Okay. One more thing. You all have done IFRS 16. One more thing which goes in P&L in lessee books, and that is depreciation. One more thing which goes in P&L of lessee books, and that is depreciation. And you know, we always depreciate ROU, this ROU. So in this question, you can see life and lease term is same. You can see life and lease term is same. Life and lease term is same. That is 5 years. That is 5 years. So your depreciation will be, your depreciation ROU will be 200,000 divided by 5 years, which makes 40,000 per annum. So one more cost that will go in P&L is depreciation. Can you add these two? This will make up 55,500. And yes, you have an answer. You have one answer, 55,500, correct answer. 55,500 is your correct answer. Okay, answer is C, 55,500. What amount is the total charge in Daniel's statement? See statement of profit and loss. Statement of profit and loss. Statement of 10% we apply on lease obligation. There is a question by a student. 10% on lease obligation, and your lease obligation, net lease obligation was 155,000. Your net lease obligation was 155,000, dear student. Now, this is a very good question. Very, very good question. And majority things are irrelevant in this question. You do it. In this question number 11, majority things are irrelevant. Just do it to the point. Now, the story is very long, but it's all majority things are irrelevant. First of all, my famous dialogue. Whenever you find a question of revaluation and there is a depreciating asset, whenever you find a question of revaluation and the asset is depreciation, you always find the date of revaluation. You always see the date of revaluation. So my dear student, your year end is 31st March X9. See the accounting period. 31st March X9. That means the beginning date of the accounting period is 1st April X8. So at 1st April X says Swizzle had a property, already property. Just ignore the land element. Nothing to do with land because we never depreciate land. We never depreciate land. It's irrelevant. Leave it. So the cost of your building is 25 C and accumulated depreciation of building is 10. Cost is 25, accumulated depreciation is 10. So right now, at the beginning of the year, building NBV. At the beginning of the year, your building's NBV net book value is 15 million. 15 million. I'm just writing in million, okay? Now on 1st April X8, on the same date, that means at the beginning of the year, please don't forget, the directors decided, accepted, yes. Directors decided to revalue the land and building for the first time, and they valued this 19.5 million. Again, ignore the land, irrelevant. So build NBV of the building was 15 and market value is 19.5. I know this thing, that building is going upward by 4.5 million. Building is going upward by 4.5 million, and this is again irrelevant for me. Just depreciation is relevant. Once we revalue a depreciating asset, from now onwards, we depreciate that asset using the market value, So the market value of the building is 19.5 million. And what is the remaining life? 15 years. It's 1,300,000. So your depreciation is A. Easy question. You guys understood it? Please tell me. Okay. Now the next two questions. You have 2 minutes each. Start at 12 and 13. 2 minutes each. You know, whenever this is you have done in IS 36. In IS 36, normally we never do impairment testing directly. We never ever do impairment testing directly. First we get the hint of impairment. First we get the hint of impairment, and there are two types of hints: internal and external hints. Internal and external hint, my respected dear students, internal and external hints. Okay, so in this question they are asking which of the following are not internal. Not internal, so you have to pick the external hints is your answer. So the assets market value has declined. Yes, the market value is an external factor. The whole market is disturbed. The whole market is disturbed. That's why market value, that's why market value has changed. Okay, so this is not internal. This cannot be controlled internally. It has. So point number one is correct. Point number two, damage or obsolescence. Yes, damage, it's our internal issue. For example, the employees are not taking care of the asset and that's why it is damaged. So it's an internal issue. So this is internal hint, and we don't have to take internal hint this time. Okay. Now the third one is changes in the economic environment. Changes in the economic. Yes, economic environment is not in my control. Political condition, these all are external factors. Changes in the way asset is used by the entity. Yes, entity is using, so it's internal factor. So 1 and 3 is the answer. 1 and 3 goes in C. 1 and 3. Yes, macroeconomic factors are external. The answer is C. Okay. Now, dear students, question number 13. Question number 13. You know, there is one standard which we called IS 23 borrowing cost. Normally in your whole life you have studied the entry of interest expense. The entry of interest expense is interest expense debit and cash credit. But this is the only standard which allows you to capitalize. This is the standard which allows you to capitalize the interest. This is the standard which allows you to capitalize interest. That means you can record interest as an asset. But again, there are some rules. If you have studied this standard, that there is a right time to start the capitalization of interest, there is a right time to end the capitalization of interest, and there are some time capitalization of interest is suspended as well. In the mid of the game, capitalization of interest is suspended as well. Okay, right? So you have 1 minute. You have 1 minute. Please have a look. Please have a look. Okay, now which of the following not true? Not true. That means you have to pick the false one. The remaining 3 are true. Just pick the false one. Only borrowing cost on college. Yes, this is true. This is true. You know, this is the definition of IS 23, that qualifying asset. And you know what is qualifying asset, which takes substantial period of time to complete. So this is true. We have to pick the false one. Capitalization of borrowing cost should be suspended if constructed. Yes, obviously. If construction is stopped, then you have to suspend it. This is also true. And now wait, read the D. Borrowing costs capitalized are net of temporary investment. This is also true. You remember temporary investment income. Sometimes you don't invest all the funds in the project immediately. So you keep it in a saving account or somewhere. So you get a temporary investment income. So what you do, you just net it off. You just net it off. And you capitalize the net amount. Now read the C. Borrowing cost can continue to be capitalized once activities to prepare the asset. No. This is false, and this is the answer. You know, once activities are required to prepare the asset is completed, then you have to stop the capitalization. You have to stop booking interest as an asset. From that date onwards, interest is your expense. So this, according to this question, this is the correct answer. Okay, next one. The balance on Olaf's development expenditure as at 31st March X8 was 16 million. Original cost 20 million, accumulated amortization 4 million. Now wait. This date is 31st of March X8. This is 31st of March X9. Originally we have cost is 20. Accumulated amortization is 4. And right now we have NBV is 16. At the beginning of 31st March X8, NBV is 16 million. Okay. Now let's check. First of all, we all know as accumulated amortization is given, that means the project has already been launched. Project has already been launched. That's why amortization has already been started. You know this concept. The development cost relate to the product called Stone, which was being amortized over 5 years. Over 5 years. Now wait, over 5 years. Can you do, when no method is given, then it's a straight line. When no method of depreciation or amortization is given, then it is always, my dear student, straight line. Now wait, this is 20 divided by 5 years. What is the per year depreciation? 4. What is the per year depreciation? It's 4. And accumulated depreciation is also 4. That means only 1 year has been passed. 1 year has been passed. 1 year has been passed. See, its per year depreciation is also 4 and accumulated depreciation is 4. That means only 1 year has been passed. And what is the total life? Total life was 5 years. So at this date, remaining life should be 4 years. Okay. At the beginning of the year, if somebody wants this data, then the remaining life is 4 years. Now, you know, in my classes, I always emphasize in the revaluation chapter as well as impairment chapter. In the revaluation as well as impairment, always see the date of revaluation and date of impairment. That is very important. Always see whether it's the beginning of the year or the end of the year. Always see whether the revaluation or impairment is at the beginning of the year or is at the end of the year. This is a very key thing. Okay. So now look at the question. A review of the sales of the stone in late March X9, that means year end, showed them to be below forecast. Now don't read forward. First of all, the whole year, then this second year has also been passed. This second year has also been passed and we were using straight line method. This second year has also been passed and we were using straight line. So one more amortization for this year. Amortization is 4. So should I bring all the data at the year end? So cost is 20, original cost is 20, accumulated amortization, now it's 8. So at the year end, the NBV is 12. At the year end means at the date of impairment. At the date of impairment, the NBV is 12. Okay. Now, an impairment test concluded the fair value of the development expenditure at 31st March X9 only 9 million. Okay. So this is the recoverable amount of fair value is 9. So we are right now we are at 12 and we have to bring down this asset to 9. We are at 12 and we have to bring down this asset at 9. So there is an impairment of 3 million. Okay. There is an impairment of 3 million. Now, read the requirement carefully. I often say this thing to my all students. Oh, F6 student, F7, F3, SBR student, invest your time on the requirement. See, what amount will be charged to profit and loss in respect of impairment? In respect of impairment, only impairment they are asking. So impairment is 3 million. Answer is B. And yes, if they ask, what if they ask, if they ask complete P&L extract. What if the examiner asks you complete P&L extract for the year ended 31st March X9? What if examiner asks you complete P&L extract for the year ended 31st March X9? Then the answer should be 4 plus 3. This should be the answer 7. Okay, but the examiner is not asking that. Okay, next. This is very routine. This is just the copy paste of IS. This is just the copy paste of IS 10. IS 10, even if you have done F3 level IS 10, you can do it. You remember the adjusting, non-adjusting events, adjusting and non-adjusting events. For example, your year end is 31st of March X9, and this is the year, this is the area of year after year end. Okay, so if an event is happening after the year end, but there is an evidence, there is a condition existed at the SOFP date, there is evidence of that event existed at the SOFP date, then that event is going to be adjusting event. If there is no evidence of such event at the reporting date, then it's a pure non-adjusting event. Okay, and then we only make disclosure. We only make disclosure of non-adjusting event. Student, please look at here. Jim is an entity that is preparing the financial statement for the year end. See, this is your reporting date, 31st of March X9. On 24th April X9, that means after the year end, clearly after the year end. Prior to the authorization of financial statement, the internal audit department discovered a fraud by an employee who had been, see the word English past tense, who had been. That means this thing was going on last year. This thing was going on last year. Who had been making payments to a fictitious supplier during the year to 31st March X9. Investigation showed that the total amount of fraud amounted to 790, considered to be material. Yes, this is adjusting event. This is adjusting event. Hope you have studied the IS, and in IS it is written that those frauds which are discovered, after the year end, but they were happening at the year end. They were happening at the year end, so they are adjusting because they were existed at the SOFP date. They were existed at the SOFP date. So this is pure adjusting event. This is pure adjusting event, right? You remember this or not, students? No doubt it is discovered. It is discovered after the year end, but it was there at the year end. It was there at the year end. This fraud was going on at the year end. Should I move forward? Please tell me. And be active, be active. These are the days of hard work. Now you have some OT cases. You have some OT cases. The first OT case relates to consolidation. The first OT case relates to consolidation, okay? So, wait. Can you guys calculate the COI from this quick? These three areas, see. Calculate the COI. Calculate the COI. All of you, please calculate the COI. All of you, please calculate the COI. Deferred consideration, indeferred consideration, all of you better know we calculate present value. Make the packets. You remember the packets: acquisition date, reporting date, acquisition date, reporting date. Come on, highlight. Okay, let's do it. First of all, 1st April, let me make, this is subsidiary. This is subsidiary. Wait. Sorry. This is S company. This is P company. And this date is 31st March X7. That is year end. Be very careful. That is year end. And 1st April X6 is the takeover date. Thank God there is no mid-year acquisition. There is no mid-year acquisition exactly at the beginning of the year. Okay. So let me make the packets. This is reporting date net assets packet. This is reporting date 20 and 84. Wait. OSC is 20,000, right? And retained earning is 84. We all know this fact that share capital never changes. Share capital never changes. Okay. So share capital remains same as acquisition date. And read the first line of the question. Read the first line of the question. P company acquired 75% shares of when Scannell's retained earning was 48 million. Tell me what is the acquisition date retained earning? Acquisition date retained earning of S company. It's 48,000. Okay. So this is the basic packets. These are the basic packets of acquisition date and reporting date. Okay. Now let's see how to calculate COI. Now it is written parent company has acquired 75% shares. Parent company has acquired 75% shares. What are the total number of shares issued by S company? Look at here screen. What are the total number of shares issued by S company? It's 20,000 shares. You can see the SOFP extract. Total number of shares issued by S company is 20,000 shares. Out of these 20,000, we bought 75%. So 20,000 times 75%, we just bought 15,000 shares. We just bought 15,000 shares. Okay. Now, Payne paid 70 million cash. First of all, cash consideration is 70 million. Wait, COI, cash 70. Now, present value of deferred consideration. Can anybody help me with that? Present value will be 8.47 million is payable on 31st March X8. That is after, right now we are at 1st April X6. Listen, 1st April X6. So end 1st April X6 to X7, 1 year, and then X8. After 2 years, we have to pay this. After 2 years, we have to pay this. Okay. So let's do discounting. $8.47. Is there any discount factor given? No. Into 1 upon 1.1 part 2. This is, I think, how much? 7 million. Okay. So your total COI is 77. Total COI is 77. Now, is it a full goodwill method question? Yes. Fair value of NCI is 24. Now, less fair value of net assets of S company. Fair value of net assets of S company. Now, wait. Let's read the fair value adjustment thing. This paragraph, my dear respected student, read this paragraph. What is written? Tell me. The fair values of the net assets of Scannell were equal to their carrying amount with the exception of building, which had a carrying amount of 8 but fair value of 12 million. Can you tell me what is the carrying value and what is the fair value? So there will be an upward fair value adjustment of 4 million. There will be an upward fair value adjustment of 4 million. Okay. Now, and what is the remaining life of the building? It's 20 years. Be careful. It's a depreciating asset. Building property is a depreciating asset. Okay. So you need to adjust both packets. All of you don't sleep. So wait, first fair value adjustment is 4 million. 4 million means 4,000. Now, look at here. look at here. Your depreciation will be 4,000 divided by 20 years. How much? 4,000 divided by 20 years is how much? 200. Okay. And 4,000 minus 200, what is the value of fair value adjustment at the year end? Yes, 3,800. Yes, 3,800. Okay. So can you please add these all? Acquisition date net asset is 20 plus 48 is 68 plus 4 is 72,000. Fair value adjustment is 72,000. Now, one very excellent point I would like to share. I hope you remember if you have done it thoroughly. You know, whatever, listen my words, whatever we adjust in the reporting date net asset packet, whatever amount of fair value adjustment we adjust in reporting date net asset packet, we add the same amount on the asset side. We add the same amount on the asset side of S company. Hope you remember. So let me do it right now, right away. In the asset side, I'll go and I'll add this 3,800 because in the end we have to do adding together. In the end, we have to do adding together. Remember, of asset side. Whatever we adjust in the reporting date net assets packet. So we have the SOFP of S company also at the reporting date. So we adjust the same amount on the asset side. Hope you remember it. Hope you remember it. Or you can do it like this. Sorry, my babies. 4,000 plus 4,000 minus 200 plus 4,000 minus 200, automatically it becomes 3,800, your wish. Okay. So now we have this fair value of net assets set 72. Can anybody tell me what is the goodwill? 29, or you can say 29,000, your wish. It depends on how they have asked. 29,000 is the goodwill. 29,000 is the goodwill. $29,000 is the goodwill. You got it? Let's see the question. First requirement. See, what is the value of goodwill on acquisition? A answer. A is the answer. Now 17 is very interesting. 17 is very good. It's general question. You tell me. When a gain on bargain purchase, negative goodwill arises. Negative goodwill arises. What is the treatment? Negative gain on bargain purchase means you bought expensive thing on a cheaper rate. So it's a gain, and gain always goes in P&L. So this is the answer. Yes, through P&L. Through P&L, your profit goes up and ultimately your retained earning goes up. But the first answer is P&L. Okay. The first answer is P&L. Answer is A. Okay. Don't do this mistake. Now, student, you tell me, what is the carrying amount of... No. Wait. First do question number 19. Then I'll come to 18. Wait. Can anybody do question? What is the carrying amount of panels, paints, consolidated PPE, consolidated PPE, consolidated PPE? Remember adding together. So on the asset side, see this. On the asset side, we have already PPE of parent company 180, subsidiary 60, plus this is fair value adjustment. So you have to adjust all these three numbers. 180,000 plus 60,000 plus 3,800. 180,000 plus 60,000 plus 3,800. How much is this? 243.8. Yes, 243,800 or 243.8. 243,800 or 243.8. Very good. This is the answer, C. This is the answer, correct. Now we have a very easy peasy thing, that is associate. Associate. For associate, we never do adding together consolidation. We do one line adjustment, equity accounting. My respected student, look at the date as well. See this, and underline this date. You have 2 or 3 minutes for this. Okay, now wait. On 1st January X7. So now your year end is 31st March X7, 3 months before the year end. 3 months before the year end. Active students, please look at here. Payne also acquired 30%, only 30% shares of 50 million equity shares. That means associate company already issued 50 million shares and we just bought 30%. So 50 million times 30%. 50 million times 30%. That means we bought 15 million shares. We bought 15 million shares, 15 million shares, okay, of Aaron paying $3 in cash per acquired. Okay, so can you tell me what is the COI? See, 15 million times $3, it's 45 million COI. Add post profits of a company multiplied by your holding percentage. Post profits of a company multiplied by your holding percentage. Look at here. Aaron made a profit of 24 million for the year ending, for the complete year. Listen, for the complete 12 months, the profit is 24 million. For the complete 12 months, the profit is 24 million. Can anybody tell me what will be the profit of 3 months? What will be the profit of 3 months? It should be 6 million. For 12 months, the profit is 24 million. So for 3 months, it should be 6 million. And what's your holding percentage? You know, COI add post profits multiply by your holding percentage. So it's 30% like 1.8. So your carrying value of investment in associate is, I think, 46.8. 46.8. Carrying value of investment as in associate is 46.8. Okay. And this is totally irrelevant. This 40 million retained earning is of no use, making you fool. Okay. I'm sure many students gave me this answer. They are writing in the chat box. That means they know how to do it. This is question number 18. Answer is B. This is question number 18. Answer is B. Last. A blind person can also answer this. A blind person can also answer this. Yes, you know, professional fees of acquisition you have done, and it's always an expense. It's always an expense. Answer is B. Answer is B. Professional fees of takeover and all these things are always an expense. Answer is B. Now, a very good question. Read this starting part. Read this starting part and calculate some data. First of all, tell me, solve it, come on, you have some time. Yes, 46.8. 46.8, we just did it. This is related to IS 36. Yes, 46.8. 46.8. Can you make the sketch? Can you make the sketch? Your accounting period is 1st of April, sorry, 1st December to 30th November. Always remember this key, that in financial reporting paper, accounting period is the first thing. Accounting period is the first thing, my dear student. Okay, so in within seconds you have to check the accounting period. So the game is starting, the whole game is starting on 1st December X5, 1st of December X5, this date, and this review is on 1st June X8, 3.5. You let me count. 1st December X5 to December X6, December X7, December X8. No, 2.5 years. There is exact gap of 2.5 years. See, exact gap of 2.5 years between these two dates. You all must know how to read the calendar. Okay, you all must know how to read the. Now they have given you the fair value, that is 105, and now the life has been changed, that it would last for a further 3.5 years. So there is an increase in life. See, originally life was 5 years. Originally life was 5 years. Now after 2.5 years, we realize that remaining life is 3.5. So just think 2.5 plus 3.5. Now total life is 6 years. So there is a change of life. There is a change of life in this question. Okay, there is a change of life in this question. Now wait, let me make some sketches. This is 1st December X5, 1st December X6. This is 1st of December X7. Okay, and this is 30th November X8. Can you see these 3 years? Yes, you can see. What is the original cost? Just I'm solving it as it is, 150,000. Life is 5 years. Life is 5 years. So what does it mean? It means 150,000 divided by 5. 150,000 divided by 5 gives you 30,000 depreciation this year, 30,000 this year, and now we are going to revalue it on the mid of the year. Revaluation to be done on 1st of June, 1st of June X8. So when there is a revaluation at the mid of the year, so first half year, we are going to calculate the depreciation using the old style, old. So old style, using the old style, what's the full per year depreciation? Using the old style, what's the full per year depreciation? It's 30. So half year depreciation is now 15. Half year depreciation is now 15. Okay. Now use your brain. Original cost is 150 less 30, 30 and 15. Original cost is 150 less 30, 30 and 15. So 150 less 75. You have NBV, or you call it carrying value. You have NBV, or you call it carrying value at the date of revaluation is 75. Okay. Now what is the market value? What is the market value? What is the market value at the date of revaluation? It's 105. So can you tell me it's how much it's upward revalued by how much it is upward revalued by how much it is up? 30. Very good. So we all know whenever there is an upward revaluation, it goes in revaluation reserve. Whenever there is an upward revaluation, it goes in revaluation reserve. It goes in revaluation reserve. It goes in revaluation reserve. Okay. Now, once it is revalued 105. Okay. So from now onwards, market value divided by remaining life. You know this? Market value divided by remaining life. So now future depreciation will be 105 divided by 3.5 years. Market value divided by remaining life. What is the per year depreciation now? Now, no. 105 divided by 3.5 is how much? 30. Okay. So 30 per annum. And now we want 6 months. So 6 upon 12, it will give you 15. Now, further depreciation is 15. So 105 was the market value. 105 was the market value at the rate of revaluation. And we brought it to market value. At the date of revaluation, we always bring the asset to its market value. Now 105 less 15. What is the NBV at the year end? It's 90,000. NBV of this asset at the year end is 90,000. NBV of this asset at the year end is 90,000. Please have a look at the sketch and we will be able to answer many questions because of this sketch. Because of this sketch, we'll be able to answer many questions. Okay. Okay, let's move the screen now. What they are asking: prior to the considering any impairment, what is the carrying amount of at 30th November X8? Come on, tell me, what is the carrying amount at 30th November X8? The carrying amount is 90, and yes, we have a revaluation reserve of 30. C answer. Carrying amount we just calculated at 30th November X8 is 90, and the revaluation reserve is 30. Now, one question. You know, you remember one thing, there was a transfer entry, revaluation reserve debit, retain earning credit, revaluation reserve debit, retain earning credit. In this question, no such policy. In this question, no such policy by the company. Let me read, let me show you. See this. See this. Okay, no such policy of company. Now, next question is, what is the value in use of Tariq's plant at 30th November X8? Very easy. Value in use means present value of future cash flows. Value in use means present value of future cash flows. I am sure you know this. So now see this thing. See this. On 30th November X8, Tariq was informed by a major customer that it would no longer be placing orders with Tariq. As a result, Tariq reviewed its forecast and estimated the net cash inflows of 3 years. Obviously, just think, at the mid of the year, we have life of 3.5 years. So after 6 months, obviously now 3 years are left. So these are your future cash flows. These are your future cash flows. If you multiply it with discount factor, what are the discount factor? 0.93 is for year 1, 0.86 for next year, and then 0.79. Students, if you multiply these three, what is the answer? If you multiply this first, 2 and 3, the answer is somebody 103,480, right? This is the present value of future cash flow, which is called VIU. This is the present value of future cash flow, which we also call VIU, which is also called VIU, value in use. So do you have this answer? You have this answer? Yes, we have A, 22A, 22A. Now, I'm sure you all remember about CGU. CGU. This is super, this part. Come on. This is the carrying value of CGU. This is the carrying value of CGU. This information is relevant. Do you guys remember? Come on, do it. This, hope you remember when you, yes, cash, never impair cash and receivable. Don't give any impairment to cash and receivable. We know this. Listen to me. Listen to me. When I was teaching you and when you guys were studying it from the books, normally the total carrying amount, carrying value of CGU, the total carrying value of CGU is compared with total recoverable amount. Total carrying value of CGU is compared with total recoverable amount, and we get the total impairment. But luckily, examiner has given you total impairment. See, this is the total impairment. This is the total impairment, 350,000. 350,000 is your total impairment. They have already given you. Now, how you do it? How you allocate this impairment? The first step. Is there any obvious impairment? No. You can't see any asset with obvious default. Okay. Now, never ever allocate anything. Never ever allocate anything to cash and receivable. Cash and receivable are already at their own value. Then next step is goodwill full written off. Goodwill full written off. Goodwill full written off. It's 0 now. So what is the amount of total impairment? The total impairment was 350. Out of this 350, 200,000, 200K is given to 200K is given to goodwill. So now your remaining impairment is 150. Your remaining impairment, this is your remaining impairment. Now remaining impairment to be apportioned, between remaining assets on pro rata basis. Now let's do it. See, this is 400, this is 350, this makes total 750, and we only have to do for plant, not factory. Leave it. This is an MCQ based question. Just do what they are asking. So the fraction will be, listen, 350 divided by 750 multiplied by 150,000 is your impairment. Come on, tell me remaining impairment. 350 divided by 750 times 150. How much? 70. So 70,000 will be given to this plant. So 350 minus 70. Finally, you will get the answer 280,000. As a student, you may ask, sir, please solve it for factory building also. No need. In MCQ, be very selfish, while solving the MCQ. Only solve that part of MCQ, that part of question for which they are paying you something, If they are not paying you something, leave it. So yes, the answer is 280,000. After allocation of impairment, the plant will be reported in your SOFP at 280,000. After allocation of impairment of CGU, the plant will be reported in your SOFP at 280,000. I'm sure you know this. Yes, I'll share the question PDF. Don't worry. After the class, I will. Don't worry. So the answer is B, 280,000, right? Now you have 2 questions and you have 3 to 4 minutes. Come on, start. 2 questions with 3 to 4 minutes. Very easy questions. (24 and 25). Do both questions, please. Thank you. Okay, 24. First of all, a cash generating unit is the smallest identifiable group of assets for which individual. Yes, true. This is true. This is total true. You all know this thing, that you can't take future cash flows. You cannot calculate future cash flows normally of single asset. 99% times you can't calculate future cash flows of single asset, because assets generates income in the form of groups. So we find out the smallest group of assets which generates independent cash flows, and that is CGU. So this is the official definition, correct. When considering the impairment of cash generating unit, the calculation of the carrying amount and the recoverable amount does not need to be based on exactly. No, it's wrong. It should be same. Just think, I have 2 CGUs. One is related to cement and the other is related to textile. Okay, I'm using carrying value of cement CGU and recoverable amount of textile CGU. Impossible. This is totally wrong. It should be same. If the carrying amount is related to the cement CGU, my cement subsidiary, the recoverable amount should also be related to the same subsidiary, same group of assets. So this is wrong. This is totally baseless words. Number 3, when it is not possible to calculate the recoverable amount of single asset, then that of its cash should. Yes. Hope you remember when you studied this IS. First you studied for single asset. Your teacher taught you for single asset. And then in the mid of the lecture, your teacher told you that normally it is very, very difficult to calculate the recoverable amount, that is value in use of single asset. That's why we go for group of assets. That's why we go for group of assets. Okay, so this is whenever there is an issue, whenever there is a problem that you can't calculate for single asset, then go for CGU. This is true. 3 is true. So 1 and 3 makes D. Now, question number 25. In accordance with IS 36, which of the following explains the impairment of and how to calculate recoverable amount? One general statement: whenever carrying value is greater than recoverable amount, impairment is must. You remember this statement? I write on my board in the class. Whenever carrying value is higher than recoverable amount, impairment is must. Okay, let's do it. Its recoverable amount exceeds. No. Carrying value must be greater than recoverable amount. So B. Its carrying amount exceeds. Yes, this looks correct. And the recoverable amount, what is the definition of recoverable amount? What is the definition of recoverable amount? Recoverable amount is higher of fair value less cost to sell and value in use. Yeah, remember the biggest benefit. And the recoverable amount is the higher of. Yes, this is correct. B is correct. C and D is wrong. You can read it. C and D is wrong. You can read it. It's all open.
Across.
Done. Now, giving you some time. I'm taking a 5 minutes break. Those who want to solve this question, they may. After the break, I'll solve this last question. Okay. So wait. First, do one thing. If you want to take the picture, you may also take the picture. See. Take the picture if you want to. Take the picture if you want to. This is the first page. And this is the second page. See. Take the picture of this second one as well. Okay. Now let me show. This is on your screen. This is on your screen. Now you solve it, please. And I'm taking a 6 to 7 minutes break. Okay. Let's start. First of all, question number 26 is a general question. Question number 26 is a general question. Now wait. Which of the following meet the definition of a financial asset in accordance with IFRS 9? They have used some bookish definition. Now, you know, in my class, I often emphasize on the book reading. If you see my lectures, I often say for IS IFRS book reading is must. In F7, IS IFRS book reading is must, because you sometimes learn some sideboard areas from book as well, some new theories, many things you get from the study text. Okay, so now the definition of financial asset, there are few definitions. If you go pure book, yes, cash is your financial asset. Yes, contractual right to receive cash is also your financial asset, but it is not written here. Cash is your financial asset. Contractual right to receive cash is your financial asset. It's not written here, but it is. Equity instruments of other entities always a financial asset. Yes, if you buy shares, if you buy ordinary shares of any other company, it's financial asset. And one more definition, and this is this: a contract to exchange financial instrument with another entity under conditions which are potentially favorable, which are potentially favorable. Now wait, let me give you one example for this. For this point number two, let me give you one example. Look at here. Today is 31st December. Today is 31st December 2021, for example, right? And let us say you and me, we both entered in a bet. We both entered in a bet. I just told you that the price of Apple company share price right now, let us say $100. Apple company share price is right now $100. And now we both entered in a bet that if this price goes up from 100, then I'll pay you the excess. If this price goes up by 100, then I'll pay you the excess. And if it goes down from 100, you will pay me the difference. Okay, right? This is the bet. Now, after 1 month, that is 31st January 2022. And let us say this bet will settle after 6 months. After 1 month, the share price of Apple goes to 96. So now, right, at that time the price was 100 and now it is 96. And what was the agreement? If it goes down, now you will pay me. If it goes down, now you will pay me the difference. So how much I won? I just won $4. So this contract is favorable for me. So it is my financial asset. And it is your financial liability. I repeat. Right now, the share price of Apple company is $100. And you and me entered in a bet. What is the bet? If the share price increases from 100, then I'll pay you the excess amount. And if it goes down from $100, then you will pay me the difference. Okay. And this bet will be settled after 6 months. Now, at the end of 1 month, after 1 month, the share price comes down to 96. So that means it is favorable. Now this contract is getting in favor of me and unfavorable for you. So when it is favorable for me, it's a financial asset because now I will receive $4 from you. And it is unfavorable for you, then it's a financial liability for you because now you will have to pay me $4, right? So this is the example of point number 2 and 3. So in point number 3, it is written unfavorable. See, in point number 3, it is written unfavorable. So unfavorable is financial liability, but favorable is financial asset. So the answer is 1, 2, and 4. 1, 2, and 4. This is the answer. Actually, this point number 2 is a technical part. It's related to SBR. You guys can watch the recording again and again. The bet was simple that right now the share price of Apple is $100. And if it goes up from $100, like it goes to 105 or 110, then I will pay you the difference. That, for example, it goes to 105. So that means from 100 to 105, the difference is $5. Then I'll pay you $5. And if it goes down from $100, for example, it came down to 90. So 190, the difference in $10, then you will give me $10. That means it's my receivable. Okay. So this is how bet is formulated. Yes, if the conditions becomes unfavorable, then it's your liability. See, point number 3. This point number 3 is the definition of financial liability, but in the question they are asking about financial asset. Okay. Now look at here. Savonic company is preparing its financial statement for the year ended 31st December X5. The following issues are relevant. Number one, financial asset. This is not financial liability, it's financial asset. Scantic acquired a short-term speculative. That means for gambling, just short-term. So short-term speculative is always fair value through P&L. Short-term speculative is always fair value through P&L. If you remember the standard, short-term trading purpose, it's fair value through P&L. Investment in 10,000 equity shares of another entity on 1st January X5. That means on the first day of accounting period at a cost of this, at a cost of this. Transaction costs are 1% of the purchase price were incurred. Okay. In fair value through P&L, transaction cost goes in P&L immediately. Okay. I'll make the entry. Don't worry. On 31st December X5, the fair value is this. Yes. At the year end, we will bring it to fair value. At the year end, we'll bring it to fair value. Right? Now, where possible, Scancovic makes an irrevocable election for the fair value movement on financial asset to be reported in OCI. They have written the word where possible. See, where possible. Right now, it's not possible. It's pure short term. It's not possible. It's a speculative instrument for short term. So right now, this is irrelevant. They are just giving you dodge. So the category is fair value through P&L, and all of you must remember, in fair value through P&L, transaction cost goes in P&L. Now let me make entries for you. Look at here. First of all, you buy shares. 10,000 multiplied by 3.5. The entry will be investment debit. And cash credit 35,000. Investment debit 35,000 and cash credit 35,000. Wait a minute, please. Wait, please, wait. Just 1 minute. Okay. Now, so you bought 10,000 shares and the share price per share is 3.5. So you bought it for 35,000. Now, what is the transaction cost? 1% of the purchase price. And you know, in fair value through P&L, transaction cost goes in P&L. So it's, I think, 350. 35,000 times 1% is 350. So transaction cost, the entries, P&L debit 350 and cash credit 350. Now, what's the fair value at the year end? It's 4.5. The fair value is 4.5 multiplied by 10,000 shares, so 45,000. Initially, we recorded the investment at 35,000. Initially, our investment is recorded at 35,000. And now the fair value is 45,000. So how much is the gain? Okay, so these are the entries. So can anybody tell me how much is the, if the examiner is asking only the gain to be reported in P&L, if the examiner is asking the gain to be reported in P&L, then it's 10,000. But if the examiner is asking the net amount to be reported in P&L, then 10,000 is your income and 350 is your expense. 10,000 is your income and 350 is your expense. So net amount will be 9650 something. One student is asking a question. Listen, sir, what is irrevocable election? You know, irrevocable means you can't change it. Then once you books a certain assets, once you classify a certain assets in fair value through OCI, then you can't take a U-turn. But in this case, you can't take it into fair value through OCI because these are short-term speculative investments. And short-term trading investment, speculative investments can never be recorded. in fair value through OCI, because fair value through OCI is a long-term category. Fair value through OCI is a long-term category. So my dear students, my respected students, go check this MCQ. In respect of the financial asset, stand to it. What is the net impact? See, net impact in the statement of profit and loss. Net impact. This is A answer. 9650 gain. 10,000 income and 350 expense. 10,000 income and 350 expense. Okay. Now the next requirement is the world's is famous requirement, because in final account you did it 20 times. You know, amortized cost category, loan, financial liability, amortized cost category. Even in my classes, I discuss this thing in very detail. Okay, students, see this. Always highlight the dates. The dates are always very skeptic issued. The party who issues loan notes. The party who issues loan note is taking liability. The party is issuing loan notes is taking loan. Okay, so it's a liability of 40 million. 5% is the coupon rate. Coupon on 1st July X5. On 1st July X5. On 1st July X5. On 1st July X5. Interest is payable annually on 30th June. Okay, after 12 months, you'll pay the interest. Now, can you tell me what is your accounting period? Your accounting period is basically this. First January X5 to 31st December X5. 1st January X5 to 31st December X5. Okay. So you issued loan notes in the mid of the year. Now, quick, very simple thing. Obviously, you have to book 6 months interest expense. Obviously, you have to book 6 months interest expense. And now, one question from all of you. Is there any discount in this question? No. Is there any issue cost? No. No discount, no issue cost. No discount, no issue cost. That means you issued at face value, which is 40 million. So your amortized cost table will start from 40 million. Your amortized cost table will start from 40 million. Okay. Now, the loan is redeemable on 30th June X9 after many years, at a substantial premium, the impact of which to increase is effective interest rate. Yes, is 7%. Very simple dialogue. We always book interest expense using effective interest rate. We always book interest expense using effective interest rate, EIR. Now, I often say this thing in MCQ, be relevant to the requirement. Don't do extra work. Please don't do extra work. Whatever examiner is asking, just do it. Otherwise, you won't be able to complete your paper. So you have to calculate 6 months interest expense. Let me show you the requirement. Wait. See this. They are asking what is the finance cost. What is the finance cost means interest expense. So you have to calculate 6 months interest expense. You have to calculate 6 months interest expense. Listen, your face value is how much? 40 million, yes. And 7% is the rate. So 40 million times 7% times 6 upon 12. That's it. 40 million times 7% times 6 upon 12. How much is this? 40 million times 7% times 6 upon 12. Tell me. 1400. Yes. 1400. That means 1.4 million. This is the answer. That's it. 40 million times 7%. They are asking interest expense, not interest paid. Yes, interest paid is calculated. Interest paid is calculated using coupon rate. We want interest expense. We want interest expense. We want interest expense. We want interest expense, not interest paid. Okay. So it's 1400. You better know this. This is not difficult thing. And only 6 months. Why? Because we issued our loan note on 1st July, right? Now the last thing is very interesting. It's about stage 4 and 5, stage 4 and 5 of IFRS 15. Stage 4 and 5 of IFRS 15. I'm sure you remember it. In stage 4, you allocate the transaction price. In stage 4, you allocate the transaction price on different separate performance obligation using standalone prices, of these obligations. Remember? Now read it. On 1st January X5, read this date. 1st of January X5 means first day of your accounting period. First day of your accounting period. 1st January X5 means first day of your accounting period. Stankovic sold a machine for 20 million. That is full and final price we received. In this 20 million includes everything. See, 20 million we received. The sale price included maintenance of the machine until 31st December X7, 3 years. See, right now we are at 1st January X5. Right now we are at 1st January X5. 1st January X5 to December X5, 1 year. December X6, 2 years. December X7, 3 years. 3 years. Okay. That is 3 years after the sale date. The list price of the machine, see the list without maintenance is 25. This is a standalone price. Standalone price of machine is 25. And Scantivic normally charges 1.5 per million per annum for maintenance. See, that means as it is a combined deal, we have given the discount. As this is the combined deal, we have given the discount. Now you just read it. I will allocate the 20 million on all of these. On all of them, I'll allocate. Look at here. See, all of you. We received 20 million and in return we give two things. The first is machine. The second thing we give maintenance service. Look at here. 3 years. Okay. Standalone price for this is 20.5 and for this is 4.5. Why 4.5? Because 1.5 per year. 1.55 per year. So that means for 3 years it's 4.5. So 20.5 plus 4.5 total is 25. And you know, we charge 20 million. We gave them total services and goods of 25 million, but we charge only 20. So now we need to allocate the discount. Wait, let's calculate the percentage. This is 20.5 and this is 25. So 20.5 divided by 25, how much is the percentage? 20.5 divided by 25 into 100, how much is the percentage of machine? 82%. Yes, 20.5 divided by 25 into 100, 82% will come here and 18% will go here. Out of this 100%, 82% price belongs to machine and 18% belongs to maintenance service. Now 20 million times 82% is how much? 20 million times 82% is 16.4 million. Very good. And 20 million points 18% is 3.6 million. Okay, so in reality, out of this 20 million, we'll allocate 16.4 million. We will allocate 16.4 million to machine and 3.6 million to maintenance service of 3 years. 3 years. 3 years maintenance service is 3.6. 3 years maintenance service is 3.6. So can you tell me what is the 1 year maintenance service? 1.2. 3 years maintenance service is 3.6. So 1 year is 1.2. Okay. Giving you 30 seconds to just think over it. Think over it. Now wait. See this. This is 1st January X5. See this. This is 31st December X5, December X6, December X7. Now, on the day one, you just provided the machine. You just gave the control. You just gave the control of machine. So 16.4 million revenue you will book immediately. 16.4 million revenue you will book immediately. Plus 3.6 million is the revenue for 3 years. So divide by 3, 1.2 million here, 1.2 and 1.2. Now, you tell me, we have to make the P&L of this year. We have to make the P&L of this first year. How much revenue we will book in the first year P&L? How much revenue will we book in the first year P&L? That is 16.4 plus 1.2. It's 17.6 million. Yes, 17.6 million will be booked in the first year P&L, the 1.2 remaining in the second year, and the remaining 1.2 in the third year P&L. This is how it goes. Take your time, take your time, take your time. Okay, now let's take the answer. It's 17.6. 29 answer is B. 29 answer is B. Now, can anybody tell me what is the answer of very easy 30? 30 is the free marks, free marks. You remember the 5 stages? Identification of contract. Yes, it is a stage. Identification of performance obligation. Yes, it is the stage. Determination of transaction price. Yes, this is the stage. This is not a stage at all. And this is the answer. Allocate the performance obligation. No. Allocate the price to different performance obligation. Remember, stage 4 is allocate the transaction price to different performance obligation. So answer is C. Answer is C. Okay. Okay. So now, students, my dear student, there are 5 steps of IFRS 15. Remember, stage 1 is identification of contract. Yes, this is stage 1. Identifications of performance obligations. Performance obligation, that contract has how many obligations? Performance. So it's also a stage. This is stage 2. Determination of transaction price is stage 3. But this line, point number C, there is no such stage in IFRS 15. There is no such stage in IFRS 15. Okay. So now it's high time for you guys. Last days are very, very important. Do revise your summaries. Do solve mock exam. I would recommend you. I think there is 1 day left. There is 1 day left for ACCA mock. So better you do that mock. ACCA mock is technical mock. In fair value through P&L, the transaction cost goes in P&L. There is one question. In fair value through P&L, the transaction cost goes in P&L. And in fair value through OCI, transaction cost is capitalized. That means it is it is the part of investment. It is the part of investment. Okay. Yes, mock will get expire after 23rd May. After 23rd May. Okay, I'll share the link. I'll share the link on the WhatsApp group. Okay, and I'll share you the slides as well. But don't forget these things. Those who are my registered students, they are requested to. I requested them to send 3 questions. 3 questions for marking. 3 questions of ratio analysis for marking. Okay, that is very important for you guys. And do solve last 40 marks on exam software. Do solve last 40 marks on exam software, please. Right? Don't forget this thing. And read the examiner report, solve mock exam, and utilize your time. Best of the best. Okay. So best of luck for your exams. So for now, it's time to say goodbye. Allah Hafiz.